If you bought above 5,000, if you bought silver above 90, and now your screen is red, that heavy feeling in your chest, that quiet voice asking, did I just make a huge mistake? That's not weakness. That's exactly what this moment is designed to create. Because every crash has two sides. On one side, panic, headlines, experts shouting, sell before it's too late. On the other side, silent buyers, waiting, calculating, accumulating. The question is not, why is price falling? The real question is, who is buying what you're being pressured to sell, and why? Stay with me, because the answer to that changes everything. Welcome to Market Metal. If you've seen a few market cycles in your lifetime, maybe 2000, maybe 2008, maybe even the 1980 silver spike, then you already know the loudest voices are rarely the calmest minds. So before we go deeper, do me a small favor, not as a trend, not as hype, but as someone who respects wisdom earned over decades. If you value clear thinking over noise, subscribe to Market Metal and tell me something in the comments. Where are you watching from today? Your city? Your country? Because this isn't just about metals, it's about perspective. The psychology of capitulation. Gold and silver are collapsing. That is the headline. That is what people see on their screens. Numbers flashing red, charts pointing down, comment sections filling with anger, regret, and fear. For anyone who bought gold above 5,000 or silver above 90, the drop feels personal. It feels like a mistake. It feels like loss. But markets do not move because of feelings. They move because of pressure. And pressure reveals who is prepared and who is not. In every major correction, there's a moment when investors stop thinking strategically and start reacting emotionally. This moment is called capitulation. It is not just selling, it is surrender. It happens when people no longer believe recovery is possible. They sell not because the fundamentals changed, but because they cannot tolerate uncertainty any longer. Right now, many are experiencing that moment. The collapse in precious metals did not begin in isolation. It began during a period of heavy leverage across financial markets. When leverage builds up, small moves can turn into violent reactions. Traders borrow money to amplify returns. Hedge funds use derivatives to increase exposure. Even ordinary investors use margin accounts. As long as prices rise, leverage feels smart. But when prices fall, leverage becomes a trap. When gold dropped from 5,600 to 4,900 and silver fell sharply in days, margin calls were triggered. A margin call is not a suggestion. It is a demand. Brokers require additional capital or they liquidate positions. That forced selling creates more downward pressure. That pressure triggers more margin calls. The cycle feeds itself. This is not a conspiracy. It is a mechanical system. It operates automatically. It does not care about long-term value. It only cares about meeting immediate obligations. Many who sold did not want to sell. Now, they had no choice. But there's another layer to this collapse, and it is psychological. Human beings feel losses more deeply than gains. Behavioral economists call this loss aversion. Losing $10,000 hurts more than gaining $10,000 feels good. That imbalance creates panic during rapid drawdowns. When investors open their accounts and see red, their brain does not calculate long-term probabilities. It reacts to threat. The media understands this. Headlines become more dramatic as prices fall. Analysts who were bullish weeks ago turn cautious overnight. The narrative shifts from optimism to warning. Fear spreads faster than facts. In moments like this, the market becomes loud. Everyone has an opinion. Everyone claims certainty. Some say the bull market is over. Others predict even deeper crashes. Very few admit that uncertainty is normal. For business leaders and entrepreneurs, this is the most dangerous phase. Decisions made under emotional stress rarely serve long-term strategy. A founder who panics during a temporary downturn can abandon a project that still has strong fundamentals. An investor who sells during forced liquidation may transfer valuable assets to someone with stronger balance sheets. History shows a pattern. In 2008, gold fell sharply during the financial crisis. Many believed it failed as a safe haven. They sold. Within 3 years, gold reached new highs. In early 2020, silver crashed during the global shutdown. Panic selling dominated. Within 18 months, silver had doubled. Those who acted purely on fear often exited at the worst possible moment. That does not mean every crash leads to immediate recovery. It does not mean prices cannot fall further, but it does mean that collapses must be analyzed, not reacted to. There is a difference between a structural breakdown and a liquidity event. A structural breakdown means the underlying thesis has changed. A liquidity event means assets are being sold because cash is needed elsewhere. During broad market stress, investors sell what they can, not always what they want to. Gold and silver are liquid assets. They can be sold quickly to cover losses in equities or other leveraged positions. That selling pressure can temporarily push prices below fair value. For experienced capital allocators, this distinction matters. They ask a simple question. Has the long-term case changed, or is this a transfer of ownership from weak hands to strong hands? Retail investors often sell at the bottom because they operate without deep reserves. Leveraged traders sell because they must. Institutional buyers, however, often wait for these moments. They hold cash precisely for periods of forced liquidation. When panic increases supply, they accumulate. This dynamic has repeated across decades. Asset classes rotate from impatient holders to patient ones. Emotional capital exits. Strategic capital enters. The collapse in gold and silver should therefore be viewed within a larger context. Equity markets remain historically expensive. Global debt levels are elevated. Sovereign fiscal deficits continue to expand. Currency purchasing power has eroded steadily over decades. None of these structural forces disappeared because metal prices declined for several weeks. Yet the immediate focus remains on the drop itself. For young entrepreneurs watching this unfold, there is a lesson beyond metals. Markets test conviction. They test discipline. They test whether decisions were based on research or on momentum. When prices rise, confidence feels easy. When prices fall, clarity becomes rare. Serious decision makers understand that volatility is not the enemy. Emotional reaction is. Right now, the collapse feels dramatic. It feels urgent. But the correct response is not speed. It is analysis. It is asking whether the selling is driven by fundamental change or by mechanical pressure. It is identifying who is forced to exit and who has the capacity to accumulate. Capitulation marks the end of one phase and the beginning of another. It is uncomfortable. It is loud. It is often misunderstood. The deeper question is not whether gold and silver are falling. The deeper question is who benefits from that fall. In every major correction, assets move from those who cannot hold to those who can. The public narrative focuses on fear. Institutional strategy focuses on positioning. The audience must now consider a critical issue. Is this collapse signaling the end of a long-term cycle, or is it signaling the transfer of assets into stronger hands? That question will determine whether this moment is remembered as a mistake or as an opportunity disguised as chaos. The analysis now shifts from psychology to structure, because understanding the emotional phase is only the first step. The real assessment begins beneath the surface, where macro forces shape the next move. The macro fragility. Beneath the surface, the collapse in gold and silver did not begin with metals. It began elsewhere. It began in balance sheets. It began in valuations. It began in a system that looks strong on the surface but carries deep structural tension underneath. Most investors focus on what is falling. Fewer examine what is stretched. Right now, equity markets are trading at valuation levels that have historically preceded major resets. The cyclically adjusted price-to-earnings ratio, which measures stock prices relative to long-term earnings, is hovering near extremes seen only twice before in modern history. The first time was 1929, the second was 2000. In both cases, optimism was dominant. Investors believed innovation would justify any price. Risk felt small, liquidity felt endless. Then conditions changed, earnings slowed, credit tightened, sentiment reversed. Capital did not disappear, it moved. When valuations compress after reaching extremes, money searches for stability. It rotates away from assets priced for perfection and into assets priced for protection. That rotation historically has included precious metals. The present moment mirrors those earlier periods in a critical way. Stocks are elevated, corporate debt levels are high, government deficits are expanding, interest costs on sovereign debt are rising. Yet the public conversation focuses on falling metal prices, not systemic fragility. This misdirection is not accidental, it is psychological. Investors react to visible volatility more than invisible risk. Gold falling 10% feels dramatic. A slow erosion of fiscal credibility does not, but fiscal credibility matters. Governments are running deficits during periods of economic stability. Historically, deficits expand during recessions and contract during growth. Today, spending remains elevated even without a crisis. Debt to GDP ratios continue to climb. Interest payments consume larger portions of national budgets. At the same time, global confidence in sovereign debt is shifting. Major economies are reconsidering their exposure to U.S. government bonds. Reports indicate that foreign regulators are advising domestic banks to reduce long-term exposure to American debt instruments. The stated reason is creditworthiness concerns. This is not a minor development. The U.S. Treasury market has long been considered the global safe haven. It is the foundation of international reserve management. If foreign institutions begin reducing allocations, even gradually, the implications extend beyond bonds. When trust in sovereign debt weakens, capital looks for alternatives. Historically, gold has filled that role. Not because it yields income, not because it generates cash flow, but because it carries no counterparty risk. It is not a promise to pay. It is an asset in itself. For entrepreneurs and business leaders, this distinction is critical. Debt represents obligation. Gold represents final settlement. In times of systemic confidence, obligation feels secure. In times of doubt, settlement becomes attractive. The question, therefore, is not whether gold prices are volatile. The question is whether confidence in traditional financial anchors is as stable as markets assume. Currency strength provides another layer of analysis. Over the past 5 decades, the US dollar has lost significant purchasing power relative to hard assets. Short-term rallies occur, temporary strength appears, but the long-term trajectory has been consistent. Monetary expansion increases supply. Purchasing power declines over time. Investors often mistake cyclical dollar strength for structural reversal. A stronger dollar can pressure gold in the short term, but unless monetary discipline replaces expansion, long-term currency trends persist. Currently, structural expansion remains in place. Debt continues to grow. Fiscal constraints remain politically difficult. Monetary authorities face pressure to support growth during downturns. And these forces do not vanish because metal prices decline for several weeks. Another overlooked factor is geopolitical instability. Trade tensions remain unresolved. Strategic competition between major powers is intensifying. Supply chains are being restructured. Energy security concerns persist. Conflicts, both economic and physical, continue to reshape alliances. Precious metals historically respond not to single events, but to accumulated uncertainty. When geopolitical risks compound, capital seeks neutrality. Gold functions as neutral collateral. It does not rely on any single government's stability. Meanwhile, silver carries a dual identity. It is both monetary and industrial. Its demand is influenced by technological growth, energy infrastructure, and manufacturing expansion. Even during financial turbulence, industrial consumption continues. Thus, beneath the price collapse lies a complex macro environment. Elevated equity valuations, rising sovereign debt, shifting reserve behavior, long-term currency erosion, geopolitical tension. None of these factors signal structural strength in traditional assets. Instead, they indicate fragility. For disciplined capital allocators, fragility creates asymmetry. When traditional systems show strain, hard assets serve as hedges. The decision to reduce exposure to metals during such periods requires confidence that macro pressures are easing. Evidence does not currently suggest easing, however, it is essential to maintain analytical balance. Gold and silver are not immune to deeper declines. If liquidity tightens further, prices could experience additional pressure. If deflationary forces dominate temporarily, hard assets may retrace further before stabilizing. But the strategic investor distinguishes between short-term volatility and long-term structural drivers. Entrepreneurs understand cycles. They know expansion leads to excess. Excess leads to correction. Correction creates opportunity for those prepared with liquidity and patience. The current environment resembles a compression phase. Valuations are stretched in some sectors. Liquidity is tightening in others. Confidence in sovereign structures is under quiet review. In such phases, the most visible asset movements often distract from the underlying shift in capital flows. The collapse in gold and silver may appear to signal weakness. Yet, when examined alongside macro fragility, it may represent repositioning rather than abandonment. The central question becomes sharper. If systemic pressure is building beneath the surface, why would serious institutions permanently exit hard assets now? The next phase of analysis moves beyond macro indicators and into structural monetary trends, because understanding where capital flows requires examining long-term purchasing power, reserve strategy, and the divergence between paper pricing and physical demand. The structural case beneath the price tells a story, but it rarely tells the full story. While headlines focus on the collapse in gold and silver, structural forces continue operating quietly in the background. These forces move slowly. They do not generate dramatic charts. They do not trend on social media, but they shape the long-term direction of capital. The first force is purchasing power. Since 1970, the US dollar has lost the overwhelming majority of its purchasing power relative to gold. There have been periods where the dollar strengthened temporarily. There have been cycles where gold corrected sharply, but over 5 decades, the pattern remains consistent. Currency supply expands, purchasing power erodes, hard assets adjust upward. This is not ideological, it is arithmetic. When governments run persistent deficits, they issue more debt. When central banks manage economic slowdowns, they increase liquidity. Over time, the supply of currency units grows faster than the supply of finite assets. The result is gradual debasement. Entrepreneurs understand dilution. If a company issues more shares without increasing earnings proportionally, each share represents a smaller claim. Currency operates under similar logic. Expansion without proportional productivity reduces real value. Gold does not expand at the same rate. Silver does not multiply at political discretion. Their supply growth is constrained by geology and extraction. That constraint matters. The second structural force is sovereign accumulation. Over the past several years, central banks have increased their gold reserves at one of the fastest rates in decades. These purchases are not speculative, they are strategic. They reflect diversification away from concentrated exposure to any single currency system. When sovereign institutions accumulate an asset consistently, they create a demand floor. They are not trading short-term volatility. They are reallocating reserves with multi-decade horizons. If gold were structurally obsolete, central banks would not be expanding holdings, they would be reducing them. The opposite is occurring. Silver presents a more complex case. Unlike gold, it carries industrial demand drivers. It is essential in electronics, solar energy infrastructure, medical applications, and advanced manufacturing. As technology expands, silver's functional relevance increases. At the same time, silver maintains monetary characteristics. Historically, it functioned alongside gold as a store of value. This dual role makes silver uniquely volatile. It responds to industrial cycles and financial cycles simultaneously. During the recent collapse, paper silver prices fell sharply. Yet physical market indicators told a different story. Lease rates in major financial centers rose significantly. Delivery requests increased. Trading volume surged. Such divergence suggests tension. Paper markets are driven by contracts. Futures, options, and derivatives reflect expectations and positioning. Physical markets reflect immediate supply and demand for tangible metal. When these two diverge, one eventually adjusts. Historically, physical demand exerts gravity. Paper pricing can overshoot in both directions. But sustained tightness in physical supply constrains long-term downside. This divergence raises a question. Are investors witnessing the repricing of value, or the temporary distortion of it? There is another structural element rarely discussed during corrections: long-term breakout levels. For decades, silver traded below a ceiling that defined its range. Breaking above such a ceiling is significant. Markets often retest breakout zones before establishing new floors. These retests can feel like collapses, but technically, they confirm structural transitions. If silver stabilizes above its former long-term resistance zone, the implications extend beyond short-term volatility. It would suggest that a multi-decade cap has transformed into support. That shift redefines valuation frameworks. For disciplined investors, these structural thresholds matter more than daily fluctuations. A correction within a breakout cycle differs from a breakdown into historical ranges. The third structural factor is confidence. Financial systems operate on belief. Belief in currency stability, belief in sovereign repayment, belief in institutional integrity. When belief weakens gradually, markets adjust gradually. When belief fractures suddenly, adjustments accelerate. Precious metals respond not only to inflation, but to trust. They function as assets outside of institutional promises. In environments where trust is questioned, even quietly, metals gain relevance. Currently, global discourse includes rising fiscal deficits, expanding debt ceilings, shifting geopolitical alliances, and strategic decoupling between major economies. These are not minor developments. They reflect systemic evolution. Young entrepreneurs observing this environment must recognize a principle. Capital migrates toward resilience. Resilience means durability under stress. Gold has survived empires, wars, currency collapses, and technological revolutions. Silver has maintained industrial and monetary relevance for centuries. Their volatility does not negate their endurance. However, endurance does not guarantee linear price movement. Corrections are inherent in long cycles. Strong trends often include violent pullbacks designed to remove leverage and weak conviction. The collapse in price does not erase structural drivers. It tests participants. There is a common mistake during downturns, assuming that price movement defines value. In reality, price reflects current positioning. Value reflects structural context. If central banks continue accumulating, if currency supply continues expanding, if sovereign debt levels remain elevated, if geopolitical tension persists, then the structural case remains intact. That does not eliminate risk. Further downside is possible. Market cycles include overshooting behavior. But structural direction depends on fundamentals, not headlines. The strategic question for serious capital allocators is therefore precise. Has the long-term monetary and fiscal framework improved materially during this collapse? If the answer is no, then volatility represents redistribution, not extinction. The analysis now advances from metals themselves to instruments leveraged upon them, mining equities. Because if structural forces remain active, the asymmetry within related sectors becomes increasingly relevant. Leverage, asymmetry, and the transfer of ownership. When gold and silver fall, mining stocks do not simply decline. They amplify the decline. That is their nature. Mining companies operate with operational leverage. Their revenues depend on metal prices. Their costs, labor, energy, equipment, are relatively fixed in the short term. When gold rises, margins expand quickly. When gold falls, margins compress just as fast. This leverage creates volatility, but it also creates asymmetry. During the recent collapse, many mining stocks fell 30, 40, even 50% from their highs. For retail investors, this feels catastrophic. It feels like confirmation that the cycle is over. But history suggests something different. Over the past 2 decades, mining equities have experienced extended periods of underperformance relative to gold itself. From roughly 2011 to 2020, many producers and junior exploration companies endured a prolonged downturn. Capital dried up, projects were abandoned, investors lost interest. That period forced discipline into the industry. Companies reduced debt, they improved cost structures, they focused on balance sheet strength. Many marginal players disappeared. The survivors entered the recent cycle leaner and more efficient. When a sector spends nearly a decade compressing, it builds a base. Bases do not generate headlines, they generate tension. When price finally breaks above long-term resistance levels that have capped growth for years, it signals a structural shift. Recently, several indices tracking gold and silver miners moved above resistance zones that had constrained them since 2013. The breakout was accompanied by elevated trading volume. In technical analysis, such breakouts often precede multi-year expansions, not brief rallies. Yet instead of celebrating that structural change, the market focused on the correction. This is where suspense enters the equation. Corrections during early-stage breakouts are common. They shake out weak participants. They test whether new support levels hold. They transfer shares from short-term traders to long-term allocators. In other words, they perform the same function as corrections in metals themselves, redistribution. For entrepreneurs evaluating opportunity, this phase demands emotional control. The most powerful gains in cyclical sectors rarely occur during periods of comfort. They occur after discomfort. But discipline is essential. Mining equities are not defensive assets. They are strategic exposures. They require time horizon alignment. They require capital that is not needed for operational liquidity. They require tolerance for volatility. Those who treat mining stocks as short-term trades often exit prematurely. Those who treat them as strategic allocations tied to structural metal cycles approach them differently. Consider the operational math. If gold stabilizes near current levels and gradually advances, a producer with fixed extraction costs experiences expanding margins. For example, if a mine produces gold at an all-in cost of $1,500 per ounce, and the selling price moves from $2,000 to $2,500, the revenue increase flows disproportionately to profit. This leverage magnifies upside. Junior miners add another layer of asymmetry. Exploration companies often control undeveloped deposits. Their valuations depend not on current production, but on future potential. When capital returns to the sector, these smaller companies can appreciate rapidly. However, asymmetry works both ways. Juniors can decline sharply in weak conditions. Liquidity is thinner, risk is higher. This is why serious investors differentiate between producers, developers, and explorers. They allocate accordingly. They size positions carefully. They avoid concentration that could damage overall capital structure. Now the strategic lens widens. When metals collapse and miners follow, the public narrative frames the move as failure. But market structure suggests something else may be occurring. Ownership transfer. When leveraged traders exit mining equities during margin pressure, institutions with longer mandates often step in. Pension funds, resource-focused funds, and sovereign entities evaluate assets over multi-year horizons. They accumulate when pricing reflects fear rather than fundamentals. Market mechanisms reinforce this transfer. Exchanges may raise margin requirements during volatile periods. This forces additional selling from overextended participants. Prices drop further. Headlines intensify. Sentiment deteriorates. At the end of this cascade, shares sit in the hands of those who can hold through volatility. This pattern is not secretive. It is structural. Markets are designed to test conviction. The title suggests that they want you to sell. In reality, the system incentivizes selling under stress. It does not require conspiracy. It requires only leverage and emotion. Those with liquidity and patience benefit when others cannot hold. For the business community, the broader lesson extends beyond metals. Cycles reward preparation. Companies that maintain strong balance sheets during expansions acquire assets during downturns. Entrepreneurs who conserve capital during exuberance deploy it during contraction. The current collapse in gold, silver, and mining equities may represent one such deployment window. However, discipline remains critical. No thesis is immune to invalidation. If structural macro conditions improve dramatically, if deficits contract sustainably, if currency credibility strengthens materially, if geopolitical risk recedes, then the case for metals and miners weakens. Investors must monitor those indicators objectively. But as of now, the underlying structural forces discussed in prior sections remain largely intact. Elevated debt, persistent deficits, sovereign diversification, long-term currency erosion, and geopolitical tension. Price alone has changed. Thus, the final strategic question emerges: is this collapse a signal of permanent deterioration or a compression phase before expansion? Markets often disguise opportunity as instability. They reward those who separate structural drivers from short-term noise. For serious decision makers, the path forward is not emotional reaction. It is measured allocation. It is liquidity management. It is analysis over impulse. Gold and silver may be collapsing in price. Mining stocks may be volatile, but the structural framework beneath them has not dissolved. The transfer of ownership may already be underway. Whether one participates in that transfer or exits during it depends not on headlines, but on discipline. The cycle will continue. The only uncertainty is positioning